Now, check this out. We have a huge report coming out tomorrow. This is the employment report, probably the number one report for the Federal Reserve and for investors looking forward. Now, this is going to sound backwards, but I think markets are going to do better if the employment report tomorrow actually comes out a little weaker than expected. Now, initially, it's going to be bad. We're going to sell off. The market's going to barf. Oh my gosh, recession. But credit is showing us, right? Credit spreads are showing us that investors are not actually worried about recession. Now, non-farm payrolls is expected to come in at 130,000. Anything below, I want to say 50,000 is not good. We don't want to see it miss by that much, but anything under 130, above 100, not bad. The market, that's going to bring down interest rates, which is going to relieve a lot of the pressure in the economy and in those risk assets. Unemployment is expected to come in at 4.2%. No change really, just one tick higher is not going to be a big deal. Now, if it ticks up by 2 points and we're at 4.4, the market might freak a little bit. No diddy, but anything below that is actually going to be good news. 4.1% unemployment. It's going to show a strong labor market in certain areas. We have a rolling recession. Some areas are strong, some areas are weak, right? Now, right now, the market is expecting the Fed to make its first rate cut in September. But if we do get this employment report a little weaker than expected, the market's going to start pricing in a July rate cut. Now, like I said, initially that might feel kind of off, like, okay, this is for a bad reason. But when you look at triple B spreads or credit, the market just wants to get past uncertainty. When are we going to pass the tax bill? When are we going to pass the Genius Act? The trade war is not escalating any further, right? We're not going to see that. Trump has shown his hand. He's not willing to sacrifice the economy. We already know that, right? He's going to say whatever he has to say. He's going to make a trade deal within the next month or so, probably pass this tax bill. This game over, liquidity surges. Now, the reason why liquidity surging is so important is because everybody thinks, oh, we're going to have this global recession or a recession in the US, whatever it is. That's not going to happen. There's way too much money in the system still. And now you have other central banks, the European Central Bank, cutting interest rates that literally, when you lower interest rates, you increase the credit in the system. What do these institutions or hedge funds do when they get more credit? They're going to buy more assets. They're buying the assets that are the most scarce. This is what drives Bitcoin and a lot of risk assets, right? So US equities, Bitcoin, you got to keep your eye on Bitcoin. Next, we have the Treasury General Account.